There are three significant foreign influences in Venezuela: China, Russia, and Iran. In exchange for political support, in exchange for military support, in exchange for what few medicine that's available for the people in Venezuela, China has provided a lot of loans to Venezuela, about $54 billion in loans to Venezuela, plus another $50 billion in investment into Venezuela. They operate oil fields and they operate refineries in Venezuela. Venezuela is one of China's largest providers of oil. In exchange for all of that, they get a favorable rate per barrel, favorable price per barrel, and they've been just taking the oil over. And even under sanctions, they were taking the oil out of Venezuela. They were using what are called ghost ships. Ships are like airplanes in the sense that they have a transponder on them. And a transponder sends out a signal, and it'll tell you what the ship is. It'll identify itself. You can plot it on GPS. You know it's a tanker. You know it's a cargo ship. You know it's an aircraft carrier. But the ghost ships don't have that. So what we were able to reserve through satellite reconnaissance and intelligence was a lot of ghost ships coming in, taking the Venezuela oil out. Generally, that oil ended up in China, even though it was sanctioned, right? It ended up in China, and it would go to what are called the Chinese teapot refineries. So in China, we have basically two categories of refiners: the large state-owned refiners and independents up in the Jilin province northeast. And those are the small refiners, and they're called teapots. A lot of the sanctioned oil would find its way to the teapots. So the large Chinese refiners, the state-owned oil companies, could report, we're not taking any sanctioned oil. We're getting our oil from, Iraq and Indonesia. Although over 90% of Iranian oil is consumed by China. So China's Iran's largest customer.
You mentioned 2 million barrels a day.
Right.
That's going to ramp up to from 600,000. How would that impact the oil prices?
Well, in economics, we have this saying called ceteris paribus, which means all things being equal. So if all things being equal, if you're adding to supply 2 million barrels a day, you'll have a favorable impact on prices in that the price will come down. The price of crude oil will come down. Now, if the price of crude oil comes down, theoretically, all things being equal, the price of gasoline will come down, and also the price of food products. There's a high correlation, very high correlation between price of crude oil, what's called the crude oil price index, and the food price index. So as we saw when energy costs went up and they reached an all-time high for gasoline in June of 2022, what did we have? Extraordinarily high food prices. When we add supply of oil to the world, given all things being equal, we'll have a reduction in price, generally a reduction in price. It has a favorable impact on the consumer. The problem that you have is if the price of crude comes down too much, then the producers of the crude oil aren't incentivized to produce it. And probably more interesting or alarming for me at least, is they're less incentivized to invest their capital in that because it's not going to have a great return on investment for them. Right now, we're sort of looking for Brent price to be somewhere between 55 and 57 for 2026, and it may even come down a little bit further. At that price point, it becomes unattractive for some producers. So they'll reduce their production and slow down their capital expenditure. But we'll see. Oil's the great commodity. The price can change in a minute. Anything can happen in the world that can affect the price of oil.
How much are these energy companies, like you mentioned, the oil companies, how much are they impacted by the price? Does the price of oil make them more, the higher price of oil make them a lot more valuable? Are they hedged on that?
There's a lot of hedging that goes on. If you're looking sort of what makes them valuable would be their technology and their access to the oil. Do they have access to it? And then, of course, the up and down of the crude price. Again, when crude prices are falling, if they fall too far, there's no incentive for that producer to make oil. they'll just sort of shut down or slow down the production until the price comes back up and they'll start producing. Right now, what we're seeing is a modest reduction in consumption, an increase in production, and an increase in oil inventories. So that's what's happening right now. That's why in California, the price of gasoline has come down. It hasn't come down because of any policies Sacramento has made. It's come down because the price of crude oil has come down. And that's true across America. So the price of crude is the determining factor. It not only makes a determining factor on us as consumers, but on the choices that the business executives will make when they're allocating their capital. So when the price is high and demand is growing, you'll see more production and higher allocations of capital for production. When demand is starting to abate somewhat and we have a surplus, which we're beginning to see being formed now, that will theoretically slow down production and slow down capital expenditures.
What is the impact of oil prices and oil on our general economy? So when the oil price is coming down, how does it impact us?
In general, energy prices, particularly oil, will account for about 30 to 33% of inflation. The largest lever or the largest impact you might have for inflation would be energy costs. And oil is the largest component of that. And we learned that lesson the hard way in the 70s under the Arab oil embargo of 1973 and then subsequent years in 77, 78. And then if you take a look at what happened under the Biden administration when there was this big political sentiment and rotation away from fossil fuels for the renewables, and we're going to restrict production on federal property, and we're not going to allow pipelines, and we want you to reduce production. Well, what happened to the price of gasoline? It reached an all-time high in June of 2022, $6.40 a gallon. It's never been that high on average. And what happened to the food prices? Spiked. What happened to general inflation? Reached 9.1%. We're complaining about inflation now to be what, 2.7%? It was 9.1 just a few years ago. Energy prices have a huge determining factor on the cost of living and inflation, not to mention the hundreds of thousands of people that are employed by the industry. So huge.
In terms of the industries that would benefit from lower oil or excess supply of oil, which are you predicting an excess supply of oil after this Venezuela move?
Well, aviation. More oil means the ability to have more jet fuel. More jet fuel should have a moderating impact or influence on prices. So we would see, hopefully, less of a price increase as a result of that for our airline tickets.
Or the companies will be more profitable.
And the companies will be more profitable. If they're more profitable, a couple of things will happen, right? Well, several things will happen. One, they'll pay more taxes. Two, that leaves more capital for them to invest in the future. We run on capital investment in our economy. Despite what a lot of people may think to the contrary, we still are a capitalist economy, which requires capital investment. And so the profits or that cash flow feeds that capital investment. That's very, very important to us. And then, of course, it's employment. These companies, when they're doing well, they hire people. So we create jobs as a result of this.